Hey gang, welcome to Time in the Market, the investing channel with a long-term focus. Taking a look at Adobe Inc., this is a medium-sized holding for me, down about 5% in the past 5 days. They just had their earnings call about a week ago. This is what's driving this dip. The earnings themselves were pretty decent, but 2024 guidance was a bit lighter than the market expected. However, if you zoom out 1 year out, up about 82%, 5 years out, up about 186%. Not quite back to all-time highs yet. The stock really boomed in 2021. Really anything was doing well back then. The stock took a bit of a dip as interest rates rose, as the invasion in Europe led to reduced guidance. There was an acquisition in September of 2022 of Figma for $20 billion, which was a 50x sales multiple at the time that the market didn't really love. And then the stock started going back up again due to the AI boom, which they've benefited from quite a bit since they do have a decent AI product going on in both their Creative Cloud and their Document Cloud space as well. So the Figma deal, market didn't love it. Doesn't really matter anymore because just 2 days ago, they basically announced that the deal was off. They don't think they can get the deal past regulators. Kind of makes sense because this is one of their bigger competitors and consolidating it all under Adobe. Not a great deal in the minds of regulators, but it speaks to the power of Adobe that one of their biggest competitors is about a 400 million revenue a year business as of 2022. So really they were overpaying for it, but they were paying because this is a business that's growing, this being Figma, growing in the space that Adobe has struggled in. This is kind of the web-based collaborative development design space, and Adobe hasn't done really well there. You can kind of look at other competitors such as Canva, that's sort of in an adjacent space as well. They just haven't done a good job there. Their Adobe XD product kind of dead, left for dead after the acquisition. Now maybe they'll resurrect it because they have to compete with Figma again, and Figma's growing. And the bad thing about this deal from the perspective of an Adobe shareholder is that there was a $1 billion termination fee that they now have to give Figma, one of their bigger competitors, to grow even more and invest in new products. If you think about Figma, they've essentially raised about $300 million, $330 million in funds to fund their growth in the past, and now they're getting a $1 billion infusion without having to dilute any of their internal stakeholders. That's a pretty good deal for Figma, even though Figma was probably betting on this being a buyout. Everybody would be rich. Kind of a bummer from them from that perspective. But now this is a business with a lot of cash they can use to grow. They can use to compete against Adobe. And hey, maybe somebody else will acquire them. Why can't somebody like Microsoft or some other big player come in and kind of say, hey, we want to start this design space. We want to get into it. It's a high margin business. Adobe's doing really well with it, so why can't we do it? I mean, that probably wouldn't pass regulatory muster either for one reason or another, because regulators seem to hate deals at the moment, but who knows what happens to Figma. But at the very least, they'll be a stronger competitor against Adobe than they were. So looking at the earnings that we just saw, pretty good, 12% growth, 13% on a constant currency basis. They have a three-pronged business. Creative Cloud is Photoshop, essentially another stuff in that ilk. Document Cloud is Adobe Acrobat, Adobe Reader, and essentially storage of documents in the cloud. And then Experience Cloud is more of their enterprise marketing and analytics space. So all of that is growing at a pretty decent clip. The nice thing about this business is, one, it's very high margin. We're talking about 40% free cash flow margins, which is one of the reasons I really, really like this stock. Second is that a lot of it is annualized recurring revenue. You can kind of see that this is a 2019 to $20 billion business, and they're talking about exiting the quarter with annualized recurring revenue of $15.1 billion for their digital media segment, which is their biggest segment. Their remaining performance obligations exiting the quarter were about $17.2 billion. So really their recurring revenue is close to 80% of their business, and it's high margin recurring revenue that is hard to complain about as an investor. The main issue with the earnings, as the market saw them, was, one, we are talking about relatively mediocre net new annualized recurring revenue in that 1.9 billion area. I think the market expected a bit more, especially since they just raised prices. Total revenue is 21.3 billion to 21.5 billion. I think the market was expecting more in that 2.2 billion range for new ARR, closer to 22 billion for total revenue. And if you kind of look at Q1 targets, you're talking about 410 million in net new ARR versus just having raised about 569 in Q4. So kind of a bit of poor guidance, but I feel like Adobe always kind of sandbags in my mind. One good view of their actual earnings power, revenue power, in my mind, is kind of looking at RPO and how that compares to next year's revenue. If you kind of look at, well, 13.9 billion in RPO, that's going to be about 78 to 80% of your overall revenue for the next year. That's kind of tracked out. So what I mean by that is 13.9 billion. Let me open a calculator. 13.9 divided by 0.78, 17.8 billion in actual revenue. You hit about 17.6 in 22. And then if you were to do the same thing for 22, 15.1 divided by 0.78, you hit about 19.35. They actually hit 19.4, so right on top of that. So if I look at it the same way, because their RPO grew at a pretty decent clip, I get about 22 billion in expected revenue based on that analysis, which is growth that's closer to 13.6%, which is better than the 10.5 they're guiding for. Again, maybe the expectations are that the net new ARR will offset that for the first time in a while, that it's going to be growing slower than it has in the past couple of years, and that seems to be the case based on the guidance. But if they're sandbagging a little bit, you can potentially get a bit more growth than they're showing, and that could be a good thing for investors. From a valuation perspective, this stock has done a pretty good job in the last year. The momentum has been there. Momentum was very negative for quite a while. I was a buyer in this space. I think my cost basis is somewhere in that $390 range, in that area. And then the momentum shifted. The AI boom took off. These guys have a Firefly product that's actually pretty good. I've actually used it to design the thumbnail, the little picture in the thumbnail on this video. It's interesting. You can type in a bunch of stuff. I think a lot of companies are doing this where they do, creative stuff in the AI space, but Adobe kind of embeds that within all of their products now, which is a really good thing. Makes their product a lot better and makes it easier for them to raise prices. They also have been using AI in the document cloud space for searching, for advice, etc. So they're doing a pretty good job there, and the stock is benefiting from it. However, on a valuation perspective, again, when I was buying the stock a year or two ago, you could get the stock in that 4 to 5 to 6% free cash flow yield range. Now it's kind of back down to, on a next 12-month basis, to the low 3% range, and that's sort of in line with the historical mean. It kind of go out 5 years or so, maybe 20 basis points below where it's historically traded on an average basis. It's certainly higher than the lows, but much lower than the highs. But even the 20% basis, you're talking about maybe a bit 10%-ish overpriced in relation to that. However, for a company like this, you do have to expect to pay a bit more. When I'm a buyer of Adobe, it's generally in that 3.5% free cash flow yield plus range, maybe closer to 4%, and especially if it's trading at 5%, because this is a very good company, right? The growth has slowed, so it's interesting to see that it's trading as low as it is, given the slowing growth. But maybe the expectations are that it starts to pick up again. However, if that doesn't come to fruition, if 2024 guidance actually ends up being true, and then 2025 guidance is even lower, that could put pressure on the stock. And if a stock historically trades in that 3.5% to 4% free cash flow yield range, and now it's trading closer to 3%, it's a bit pricey in my mind, especially as growth is slowing. However, you do have to pay up for a business like Adobe. Free cash flow yield is one thing, but free cash flow margins of 40% plus are very impressive and something to keep in mind. So let us look at the valuation here. Disclaimer: video is purely for informational, educational, and entertainment purposes only. It is not investment advice. Do your own due diligence. So we're talking about valuation. Stock is at $599.13 pre-market today. That's a free cash flow yield of 2.5%, a forward free cash flow yield of 3.2%. If you kind of think about, well, what if I want to buy this stock at a 3.5% free cash flow yield? That would be a price point that's maybe almost 10% lower than it is today. That's just kind of how I look at it. If my minimum is 3.5% free cash flow yield, I would want it to be at least 10% lower than it is today. So as I look at the revenue growth here, the estimates here I'm going to ignore, and I'm just kind of going to assume about 10% growth on a go-forward basis, 10.5%, which is their guidance for 24, 10.5% for 25. kind of growing based on some price increases they're going to pass through, maybe some margin improvement all the way up to 41%. Talking about a 40% of their, looking at 40% of their free cash flow being used towards buybacks, which is about 21 billion in the next 5 years. That accounts for stock-based compensation as well, which they do about $500 million of every year. That's kind of in line with what we've seen in the last couple of years. I think what's possible is that they say, well, the Figma deal is called off. That's a $20 billion we don't have to spend and or issue in stock. Maybe we'll improve our stock purchase plan and buy back more shares. Certainly possible. This doesn't really account for that. This is kind of just the daily assumption. But if they buy back more shares due to the Figma deal being called off, this could go up and make for a better buyback yield. As I look at the scenarios, again, I'm talking about 3 to 5% free cash flow yields is where I feel comfortable with this company. 40% of the pricing goes into the 3% free cash flow yield, 40% goes into the 4%, 20% goes into the 5%. You can play around with these however you want. Revenue growth, buybacks, scenarios. Just file, make a copy. I'll share this sheet down below. As I look at it that way, I kind of expect a 6.3% return based on the $599.13 price point today. Not too amazing, certainly not bad, but again, it all comes back to how the market prices it. Not too long ago, the market was pricing this close to 5%, and if the market kind of shifts back into that scenario, you're talking about a flat return from today's price point, essentially a fair value of about 384 if you want a 10% return on a 5% free cash flow yield. If the market continues as it is and kind of says, well, the free cash flow yield based on current returns is closer to 2.5%, you're talking about a 14% return based on the growth and margin expansion and a fair value of about 723. So really, it depends on how the market values a company like Adobe. And there's been a big variance here because momentum can shift up really quickly on a company like this and can shift down really quickly on a company like this. For me, because this is a good company, I generally wait for the momentum to shift negatively when I can, when it does, if it ever does, and it certainly did a year ago when you could buy this close to 4 to 5 to 6%. That was a good time to buy. I was a buyer. Now, because of where the free cash flow yield is, even if you look at it from a next 12-month perspective, you're still looking at about 3.2%. That's not bad, but it's not amazing, right? I'd rather be closer to 4% for a company like this. And again, 3.18 divided by 4 is 20% lower than it is today. Is the stock price going to hit that? Not sure, but I already own a sizable position for Adobe, and I'm not sure I want to expand it at today's valuation. So for me, based on these scenarios, based on a target return of about 10%, I'd really aim for a price closer to 513, which is about 14% off where it is today. Really, I'd probably want something a bit lower, probably closer to a 4% free cash flow yield, which would be closer to 20% off of today's price point to really start to size up my position in a big way, because I do think Adobe's a really good company. There is some risks though, because the Figma deal is called off. They're funding it. Companies like Canva are out there. And by funding it, I mean Adobe is giving Figma $1 billion to grow, right? That's weird. I think Adobe struggled in that web collaborative design space that Figma has done so well in. I think Adobe has some headwinds against it as well. There's a FTC investigation around the practices that they have in terms of charging people to cancel their product, to making it harder to cancel their product. Some potential fines ahead for them, which could put pressure on the stock. Again, they have the balance sheet to support it, but it all depends on how big the fine is, how that impacts their ability to buy back shares. If the fine is huge, it could be problematic for Adobe, but also could mean that there's an opportunity to buy at a much lower price. So that's something to keep in mind. What's going to happen in the competitive landscape? Will they go back to Adobe XD and kind of work on that product some more based on what they learned in doing their due diligence with Figma before the deal was consummated? I mean, they were still separate companies, but I'm sure they were at least talking and working together in some fashion. Has that been beneficial to them in any way? Is their growth actually slowing? They're passing through price increases. They are offering more products within their suite of products. But again, one thing people hate about Adobe at times is they have to subscribe to it now, right? 10 years ago, or however long, you could just buy Photoshop for $100 or however much it cost, maybe more, and just own it forever. Now you have to pay $20 to $60 a month as a user, depending on what you want. And that's an every month type subscription. in order to use the product. And again, sometimes they make it harder to cancel. They have early termination fees, stuff like that, which is being investigated by the FTC. So certainly some headwinds that they have. How will Figma do? How will Canva compete with them? How will these other players compete with them? Now, this is certainly a business that people should want to get into. Anytime a company generates 40% free cash flow margins on 20 billion in revenue, this is a business that other people should want to get into, and certainly competitors are springing up. And I think it's going to be tougher for Adobe in the future than it has been in the past, which is why you're starting to see their rate of growth slow down. Again, they're a bigger company. Rate of growth is going to slow down as your revenue gets bigger. But there's only so many price increases you can push through if there are better and more prevalent competitors out there. So it'll be interesting to see what Adobe does in the future. I think great stock, great company, one I want to own for the long term. Again, if it keeps going up and the price point gets crazy, I might sell. But for now, I'm comfortable holding, even if the expected return isn't that high, because who knows what the market will do? Who knows what acquisitions they make? Who knows what they do with the additional money they have? They are a free cash flow generative machine. I love companies like this. I want to hold them for the long term. But if I want to buy more, I need to have a pretty compelling valuation. And at $5.99, it's not really all that compelling. So for me, it'd have to drop, 15 to 20% for me to size up my position and make it a top 5 position potentially, because this is a company I do like. It's just that the valuation isn't there just yet. So let me know what you think about Adobe, what you think about the deal being called off, what you think about the earnings. As always, like, subscribe, leave a comment down below, all of that good stuff. Thank you for watching. Hope you enjoyed the video. Bye.